I am Scott Olson, co-founder of LTCshop.com and author of Long-Term Care Insurance Now. Why did over 100 insurance companies stop selling traditional long-term care insurance? Now, here's one of the biggest half-truths about long-term care insurance that you'll ever hear. You're ready. Here it is. Insurance companies are fleeing from traditional long-term care insurance. That's only half true. Here's the full truth. Insurance companies have already fled from traditional long-term care insurance more than 20 years ago. Here's a little background for you. In the 1990s, there were 173 insurance companies that sold long-term care insurance. By 2003, the number of insurance companies selling long-term care insurance fell below 20. Here's the chart. You can see it for yourself. Now, since 2003, the number of insurance companies selling long-term care insurance has been relatively stable, anywhere from 10 to 15 companies at any given time in most states. So what happened? What caused over 150 companies to flee traditional long-term care insurance between the year 2000 and the year 2003? Well, it was what's called the Rate Stability Regulation. In December 2000, the National Association of Insurance Commissioners created a new regulation for long-term care insurance pricing to try to prevent rate increases on newer long-term care insurance policies. The regulation was designed in such a way so that eventually long-term care insurance premiums would become stable. The regulation rewards the insurance company with higher profits if they keep premiums level. The regulation punishes the insurance company by forcing them to lower their profits if they request a rate increase. Most insurance companies did not like this regulation, so many of them decided to stop selling new long-term care insurance policies after this regulation was adopted. The National Association of Insurance Commissioners created the model for the rate stability regulation in December of 2000. Before the regulation took effect, each state had to pass the regulation. States began to adopt this regulation in late 2001 and 2002, and it's now been enacted in 41 states. The regulation took effect in Idaho on July 1st, 2001. Oklahoma was the next to pass the regulation on November 1st, 2001. 7 more states passed the regulation in 2002. By early 2003, both Florida and California passed the regulation. Those 2 states had by far the biggest market share for long-term care insurance. Once the insurance companies saw the 2 largest states adopt the rate stability regulation, those companies said goodbye to long-term care insurance, and they stopped selling new policies in 2003. That is why over 100 insurance companies stopped selling long-term care insurance sometime between the year 2000 and the year 2003. Today, the companies that sell long-term care insurance specialize in it. They are making a profit, and they know what they're doing. Most insurance companies used to sell dozens of types of insurance. Now, most insurance companies sell only a few types. They have had to specialize in a few product lines and reduce overhead in order to increase profits. Today, in most states, there are 10 different companies that specialize in and sell long-term care insurance. And most of those companies have A ratings for financial strength, and on average, they've been selling long-term care insurance for over 27 years. So are insurance companies fleeing long-term care insurance? No, they've already fled. The ones remaining are the ones that specialize in long-term care insurance and know how to offer solid policies with reasonable premiums. Thanks for listening.